Welcome to your Monday morning market update here. We're going to be looking at a couple of things today, a couple of things regarding the Fed. Number one, the Federal Reserve has recently announced that they're going to be deleting massive data sets from their database, which is odd. Number two, the Boston Fed, in conjunction with MIT, has made further progress on researching a CBDC. And then number three, there is a new energy loan that is being imposed. It's mandated, it's enforced on all UK citizens, turning people into small debt slaves there for energy. And we'll also be looking at what the markets are doing to start the week off. Ready? Let's dive in. All right, guys, you can see we're on the St. Louis Fed website here. This is from just a couple of weeks ago on January 10th. And I just saw it because you guys are always sending me stuff, especially on Twitter. And I just saw it recently. And so thank you for continually sending me things like this that are popping up, because there's so much happening that it's hard to keep track of everything. But on January 31st, which was 1 week ago, as of the time of this recording, they stopped including specific parts of data from their data sets. They not only are not reporting them anymore, these data sets are deleted from their Fred database. Now, Fred, if you're not aware, anytime you've seen me post a chart from the Federal Reserve, that's going to be the Federal Reserve balance sheet or the Treasury General account or the federal funds rate or anything like that. That's coming from the Fred database. So number one, they're getting rid of LIBOR rates and swap rates. Number two, a little bit odd, they're getting rid of the the gold price and the silver prices here. The daily prices. So there's no explanation given for this. I would say that this, from their point of view, one of the reasons is probably just that this data to them is useless. It's not being used for anything, and it's possible that there's a cost associated with gathering and maintaining the data. Although there's also a possibility that this data might be being excluded from their database now because of how it impacts metrics that they're actually using to watch the economy. Again, there's no indication given as to why, and if you have links that reference this data, it won't work anymore, because the data is not just like stopping, being updated like we've seen recently. The M2 money supply data series change. It doesn't update anymore from on a week-to-week basis. There's like a month-long lag here. So if we look at the M2 money supply here, we can see that the most recent week here is January 3rd. So it'll still post every single week, but there's a lag of at least a month in between when data comes out and when it actually posts. And so it's not like that. They're actually deleting all the data, so you won't be able to look up the data anymore. Second thing here, this article is from MSN.com. The Boston Federal Reserve has the Federal Reserve Bank of Boston and MIT have teamed up, and there's some new research that they've developed on a CBDC that they recently published. And this is separate from I made a video, I don't know, probably a month or two ago about the Federal Reserve Bank of Boston was was developing a new team that was dedicated to researching CBDCs. So this is separate than that. This is something separate that they did with MIT. And we can see here Project Hamilton, and they've been experimenting, doing some research. And one of the things here is that they produced, a code capable of handling 1.7 million transactions per second. And so that's key with something like a CBDC, especially if it's, potential is to replace the dollar. The massive amount of transactions it would have to handle is up there. And so having it handle a lot of transactions is important, because you wouldn't really have, like with Bitcoin, that's one of the main arguments against it, is that it's too slow and inefficient to be able to handle worldwide transactions. And so there are layer 2 solutions on top of that. And you can do that because of the simplistic nature of Bitcoin and how how it's designed basically for just that one purpose. And so you can have layer 2 transactions that settle on Bitcoins on the blockchain, but the layer 2 transactions are a lot more efficient and quick, like the Lightning Network. You can't really have that here because you need, it's not, first of all, it's a private ledger. It's not a public ledger for a CBDC. You don't everybody doesn't have access to those transactions and the people, the wallets. It's only the Federal Reserve and the banking institutions who will operate as the infrastructure for it. And so you've got to have all the transactions go through on that layer 1 so that they can track it all and they can see the data and they can process it themselves. Because the reason for a CBDC is so that they can stop transactions that they don't want to happen, and they can credit the wallets that they want to credit, and they can debit wallets that they want to debit, to fine-tune economic policy down to the individual and business account level. And so it's important that it's able to handle many transactions per second, because it's got to be able to handle that load. You can't build a layer on top of that. Again, one of you notified me about this as well, so thank you. And third, same thing here. Thank you for sending this to me. The UK now has a program. It's a £200 energy bill loan. So basically the way this works in the UK, there's a $200 bill credit that's going to be applied to all households. So you're going to pay your normal energy bill, and then it's going to be £200 less than it normally would. So you're going to get a little bump, alleviation in that bill. And then every single April for 5 years, the bill will automatically increase by £40 a year to pay that back. So the way that this works is there's not individual loan accounts. This isn't, going to, operating like that. It's just kind of applied to all utility bills generally. And so if you are living in a household where you're not the one responsible for the utility bill, the electric bill, then you're not going to be getting that $200 credit. It's whoever's going to be paying that bill. Subsequently, in a year or 2 years, if you end up moving out and you get your own bill, you're still going to have your bill increase by that £40 per year, because this is just kind of distributed evenly throughout all of the electric bills. Now, the reason for this was to help households with the rising cost of living, looking like energy bills were going to be rising by £693 per year. And so instead, they're turning this into an opportunity to it's not really turning people into debt slaves here. It's a very small amount, and it's not individual debt accounts. It's not individual loans. It's not anything like that. But it is one of those things where, kind of like a subsidy that ends up costing more later. We don't know what the long-term ramifications of this will be. My guess would be this increased $40 a year for 5 years will probably end up being, at the end of the 5 years, the policymakers are going to be like, look, we spent a lot more than we actually got back from that increased £40 a year. We need to increase it by, another £60 a year for the next 5 years. And so it's, that's the typical way that these things work out. They end up spending a lot more money than they actually had. And so we'll see if that's where it ends, but you don't typically help the long-term cost or efficiency of projects by subsidizing them or giving people the ability to not have to pay as much for them. Usually the effects of that long-term are counterproductive to what the original intent is. Moving on to the markets, we're going to look at gold first. Gold is having a strong morning to start off the week here. It is up just about 0.5%. We can see, this long-term ascending trend line here. It has recently, over the last 7 trading days or so, bounced off 4 times basically. So that's really strong indication that support line is holding, and we've had a strong rally at the bottom there. And last time, I've made a couple videos about gold recently. Here I was saying it's likely we bounce off, and then we did. And so we're consolidating here. It's unclear how long we will consolidate into, the very end of this triangle here. At some point, we will break out either to the upside or the downside, given the long-term trends here, and given the current pace of monetary policy. I would anticipate we've got a higher likelihood of continuing the bull market, not breaking out to the downside. Moving on to silver here, not as pretty of a chart, a little bit more ugly, but we're still seeing some strength off of this, $22. The other day we hit $22 again, and that's been some pretty good long-term support here down at 22. So we're seeing some strength out of silver today, up about 2%, almost to $23. And so we're seeing some strength out of silver today. And if the metals do enter a new, renewed bull market here and start heading up higher, usually silver moves faster than gold, either up or down. So that's why we're seeing silver up 2% with gold up about 0.5% today. Moving on to Bitcoin, it looks like it might have finally snapped its losing streak here. It's bear market really from almost 70,000 down to 32,000. That's from top to bottom there. That's more than a 50% drop. And so we had, a lot of selling there, a lot of weak hands shaken out. And so it's looking like that might finally be over, although time will tell. And, starting to head higher here after it briefly hit that just below that $33,000 mark. Moving on to the markets, we're seeing not a lot of action out of the stock markets so far. The S&P 500 fairly flat, up about 0.25%. Same with the NASDAQ, same with the Dow, and same with the Russell 2000, up about 0.5% here. So not a lot of volatility, not a lot of movement out of the equity markets here. It's causing the VIX to be slightly lower. The VIX is the volatility index that measures the price. Just for anybody who doesn't know how the VIX is measured, it is calculated using the price of at-the-money options on the S&P 500. And so the reason that works fairly well is because if you are going to sell an at-the-money call on the S&P 500, you're going to sell it at a price in which you think it is going to expire worthless. And given supply and demand and all the available sellers and buyers, then that will usually bring the equilibrium of that price to the general market consensus on how high the stock market might go until expiration. Same thing with the puts. If you're going to sell the puts, you're going to sell them at a price at which you think the price the contract will expire worthless, even if the stock market falls. And so again, supply and demand equilibrium will provide a general consensus on how far the stock market might fall until expiration of that contract. And so by measuring the price of at-the-money options on the S&P 500, you get a consensus on where the market expects the potential price range of the market to be during that given time frame. And so VIX has fallen just a tad bit today. We'll see where it ends up throughout the week. The dollar, again, fairly flat, just like the equity markets. And we're seeing a little bit of consolidation, not much movement out of the 2-year because we had a massive rise in the 2-year on Friday. 10-year, 20-year, and 30-year are all, the yields are all going up here. And so we're seeing a little bit of a steepening in the curve. We're seeing, not much movement out of the 2-year, a lot more movement out of the 10, and then more movement out of the 30 than the 20. So a little bit of a steepening of the yield curve here. And then finally moving on to oil, again, not much movement, a little bit of sideways action here, consolidation after a few strong days of rallying ahead. So we'll see what this market has to bring this week. Not much news after last week, and over the last couple of weeks as we've seen, this massive drop in equity markets and then a rally. It is looking to me like this is, the just consolidation to establish a kind of a short-term new base here as we continue much higher. There was a lot of selling here. A lot of money got shaken out, and the markets are, in my opinion, going to be rallying much higher, giving the Federal Reserve room to continue tightening. That will increase rates and cause an air bubble to form underneath the markets, underneath the economy here. And we're going to see markets rally higher into that before an inevitable crash, collapse much later this year. And so that's what we're looking at for the week ahead. As always, thank you so much for watching. Have a great day.